Hello everyone, it's been a while. Today Annie has gathered a few pieces of news to share with you. Lately, Central Huijin has taken action again, but the market still shows no signs of improvement. Has the national team's market rescue effort lost its effectiveness? In fact, the overall market valuation is currently at historically extreme levels, with limited downside potential. As of October 23, the Shanghai and Shenzhen 300 index had a forward PE ratio of 9 times and a forward PB ratio of 1 time, down 14% from the peak in May and well below historical averages. The forward PE ratio for non-financial stocks is at 12 times, below the historical average. The variation of Chinese index is near all-time low, and the variations of blue-chip stocks favored by quality institutions have reached new lows in this round of corrections. From the perspective of equity risk premium, this of the Shanghai and Shenzhen 300 index is above the historical average by one standard deviation, indicating a relatively high level, similar to the levels around October 2022, March 2020, and December in 2018. However, why hasn't the injection of funds by the national team led to a rise in A-share or Hong Kong Stock Index? This is due to a combination of internal and external factors affecting the recent market correction. Internationally, U.S. bond yields has risen rapidly to historic highs. The Fed's tightening cycle is not over yet, and the increased net supply of U.S. bonds, coupled with escalating global geopolitical conflicts, have driven U.S. bond yield to briefly exceed 5%, the highest since 2007. The persistently high U.S. bond yields have affected global fund flows, with both A-shares and Hong Kong stock reckoning net outflows from overseas funds. This has exacerbated the negative feedback effect in the context of a relatively tight domestic capital market. Also, domestically, asset prices have not yet reflected signs of a marginal improvement in the economy. Recent indicators such as PMI, manufacturing investment, exports, consumption, and PPI show signs of stabilization, but the weakness in real estate investment and sales remains to be improved. Investors have high expectations for further counter-cyclical policy adjustments. The better-than-expected GDP growth in the third quarter has not yet been reflected in asset price, given concerns about real estate and other factors. In light of the above factors, some major indexes have dipped below the low point of October 2022 after continuous adjustments. It is believed that the current market position and valuation imply a more pessimistic expectation. Some economic indicators show signs of marginal improvement, indicating the previous policy measures have had a certain effect. In terms of the capital market, Central Huijin has been continuously increasing its holdings of large banks and index ETFs, with a commitment to continue doing so, and more listed companies are releasing shares buyback plans. These positive factors are accumulating gradually. Moreover, today, the People's Bank of China conducted 393 billion yuan of 7-day reserve repo operations with an interest rate of 1.8%, which is unchanged from the previous operation. 710 billion yuan of reserve repo operations are due today. The chart below summarizes the historical timing of the national team's interventions, and historically, after Central Huijin increased the holdings in ETFs, the market often stabilized. Additionally, some reports suggest that the reason for A-share instability is the massive outflow of foreign capital. As a result, a researcher from the Institute of World Economics and Politics at the Chinese Academy of Social Science stated that China's advantages and potential in attracting and utilizing foreign capital has not diminished. According to the latest data released by Ministry of Commerce from January to September in 2023, there were 37 new foreign invested enterprises in China, an increase of 32% compared to the same period last year. Therefore, from a macro perspective, The proposition that foreign capital is leaving China does not hold. Even though stock values and economic data hasn't reflected good news and market sentiment is subdued, we hope the recent action of the national team can once again successfully boost investor confidence. Let's wait and see for better days. Lastly, here's the last piece of news. At 8 p.m. tonight, the 2023 Tmall Double 11 pre-sale officially begins. On top of the spend 300 yuan, get 50 yuan off promotion, it introduces official instant discounts on products. The platform has also launched the most extensive red pocket subsidies in history. VIP members can grab the first wave of 860 yuan worth of the large consumption coupons at 8 p.m., which is the highest denomination ever. So that wraps today's news. Stay tuned for tomorrow!